We're going to break down one of the most important charts circulating right now. It's an adoption curve comparison showing how quickly major technologies reach US households. And I think you should know. And where artificial intelligence fits within that historical timeline. This image, which is sourced by the New York Times and World in Data, visually compares the first 25 years of adoption for electricity, radio, the internet, cell phones, smartphones, and now artificial intelligence. A lot can be learned from this chart. And what it suggests is nothing short of revolutionary. Let's go through it slowly, clearly, and analytically. First, the vertical axis shows the percentage of U.S. households that adopted a given technology. And the horizontal axis shows the 25-year time spent for each technology. From the moment it began its consumer-facing rollout. You'll notice five historical lines. The first one, electricity, radio, internet, cell phones, and smartphones. Each of these technologies transform the economy, society, and daily life. But each followed its own adoption curve. Some slow and steady, others explosive. Now, look at the blue line, right? The blue line represents what everyone is concerned today, which is artificial intelligence. It's barely a few years in its twin cycle, and yet it is already showing a slope in acceleration steeper than any other technology on the chart. This is a story we need to understand today, why AI is on track to become the fastest adopted consumer technology in history, and what that means for households, businesses, markets, and policymakers. So, historical context. First, when electricity began rolling out, infrastructure had to be built from scratch. Power plants, wiring, grid system. It took decades before even half of the country was connected. Radio spread faster, partly because it's piggyback on electrification and still required hardware manufacturing, broadcast networks, and distribution. The internet accelerated even more quickly than that and already electrified society. You see how everything builds on each other? And we'll talk about, the AI bubble as well. The internet accelerated even more quickly. Then cell phones and smartphones took off, reaching mass adoption in under 15 years, an extraordinary feat that transformed communication, commerce, and culture. But even these innovations required physical infrastructure, cell towers, satellites, chips, modems, operating system, handsets. All this had to be created. Artificial intelligence is different. Why? Why is AI different? It's not a physical device. Think about it. It does not require consumers to install hardware. It doesn't need a grid, new cables, new towers. AI rides on top of everything we already have. It can be adopted instantly, globally, though the devices people already own can be used for that purpose. That is why the early adoption slope is so steep and frictionless. Now, of course, yes, it does need the huge warehouses of data centers. Okay, but that's it. right? It doesn't require all that additional technologies and data centers. We've had data centers for years. So let's analyze the drivers behind this unprecedented acceleration. Well, first of all, zero hardware cost. Consumers don't need to buy a new device, right? Your phone, your laptop, your tablet, they already have AI installed already. It's there. You don't need to, like when you have to get the cell phone. Well, I need a cell phone, otherwise I can't access my apps. Not any longer. AI tools can be deployed overnight to hundreds of millions of users. No shipping, no manufacturing bottlenecks, no supply chain limitation. AI is embedded into existing apps. People adopt AI without even knowing it. It's autocomplete, recommendation algorithm, AI-powered customer service, photos, video enhancements, productivity apps, search engines transforming into chat-based interfaces. This is passive adoption, which accelerates the curve even further. Businesses are adopting AI even faster than consumers. Think about that for a second. Unlike previous consumer tech waves, okay, like the radio and the smartphones, AI is being deployed at the enterprise level simultaneously. That's why this curve is so steep. Companies don't wait for public adoption. I don't need you to agree or not agree. I don't want to sell you a phone. They integrate AI to cut costs, automate workflows, optimize decision, and gain a competitive edge. And that's what you need to understand. You need to understand the difference because it impacts your job. And this thing could be deployed like that. AI improves itself. This is the best part. This is a key differentiator. Electricity didn't get better by being used. The smartphones, for example, they didn't improve automatically while you slept, but AI does. You don't realize, but whenever you talk to ChatGPT and you tell it thing and look for this and look for that, it's learning. It's understanding your way. And it is getting better and better and better at understanding your needs. So every interaction leads to more training data, more fine-tuning, more capability. This creates, and hold on for your knickers, a self-accelerating adoption loop. Oh, it feels like it's talking to me. It understands me. So what does this steeper curve mean? Well, when adoption happens faster than expected, several macro effects emerge. One, economic impact accelerates. Past technological revolution took decades to shape the GDP, productivity, industry structure. AI may reshape all this in under 10 years. I mean, think about this for a second, right? When there was no electricity and when there was electricity, well, people didn't go out. People didn't do lots of different things. They didn't do lots of different work. But now it's different, right? You go out at night because there's electricity everywhere. It changed your way of life. Well, it took years before it happened. But this is happening within the next 10 years. If you're here listening to this, understanding what I'm saying, then you should realize that this is going to be major. Entire job categories don't have decades to transition. They may have 5 years or fewer. That's why a lot of these people are losing their jobs because of AI. But lots of people are gaining jobs because of AI. You need to understand what it does. Workers, investors, policymakers must adopt at a pace never before required. That's the reason why I want my subscribers to understand what's going on, so that they take advantage of it and realize this thing is moving fast. This thing is moving very fast. Market valuations grow ahead of fundamentals. We are seeing this already. AI-exposed companies trade at a significant premium because investors anticipate exponential growth. This chart that you're seeing implies that may be right. Adoption curves often predict revenue curves. And of course, because adoption is frictionless, some companies that will scale to billion in users almost overnight. Others who fail to integrate AI may experience a faster decline. So, why AI may surpass 80% adoption faster than any other technology? Well, if the curve continues at the current pace, AI could surpass 50% household adoption in under 5 years and 80 in the next 10. Why? Because AI is not a standalone technology. It's a utility layer like electricity, but programmable, adaptive, and constantly improving. AI becomes the new electricity, but faster. Electricity took decades to spread. AI spreads through the cloud in seconds. AI integrates into everything: cars, healthcare, finance, education, entertainment, consumer products, business software, government services, and household automation. Once AI becomes embedded into most tools, it becomes unavoidable. Just like electricity or the internet, you cannot avoid the electricity today, can you? AI lowers the skill barrier for complex tasks: editing video, coding software, analyzing financial data, creating art, managing a business. Tasks that required specialized training now require only one thing: explaining what you want. This expands the user base. So the question is this: what are going to be the implications for the next 5 to 10 years? Well, let's look ahead. Productivity boom potential. If half the workforce augments their task with AI, the US may enter a once-in-a-century productivity jump similar to electrification or the PC revolution. 2. The AI disparity problem. Fast adoption means unequal adoption. People say, what? Households with AI skills and tools may leap ahead economically. Those without access or training may fall behind. This become a political or social challenge. Remember at one time they wanted to make sure that people in the middle of nowhere still got cell phone coverage? Otherwise, they'll be cut off the world. That's going to be the same thing. Regulation will lag behind. It's going so fast that every technology on the chart experienced a lag between adoption and regulation. Antitrust in telecom, privacy laws for the internet, app store regulation for smartphones. AI pace means the gap will be larger and riskier. AI becomes a requirement, not an option. Much like internet access today, AI literacy will become a baseline requirement for jobs, education, financial decision making, daily life navigation. You need to get onto the AI bandwagon. Fast, especially for your job and for your business. So at the end of the day, in conclusion, this chart isn't just showing adoption, it's showing acceleration, a rate of change unlike anything in modern technology history. Artificial intelligence is not following the pattern of electricity or smartphones. It's compressing decades of adoption into years. And if this trajectory continues, AI will become the fastest, most transformative, and most deeply integrated technology humanity has ever adopted. The question is no longer whether AI will reshape society, and it's how quickly, and whether we are ready for the velocity of the change ahead. So keep that in mind while I'm moving to discussion number 2. What are the 5 risks? What are the 5 risks in 2026? Okay, we talk about AI, we talk about lots of things, we talk about the Fed, we talk about the tariffs, but at the end of the day, what you want to know is what is it that's going to be risky in 2026? So let us break down the top 5 risks in 2026. This should capture the tension between a world that wants growth and a world constrained by inflation, politics, and structural realignments. So let's go calmly, clearly what's going on. Risk number 1. The US reaccelerates and inflation comes back. The first risk is the US economy starts to reaccelerating because of the fading trade war shock and the one big beautiful bill. This is a warning. Why? Well, as the trade war shock fades, through 2024 and 2025, tariff escalation created a temporary drag on demand because people say, what the heck is going on? Supply chains had to reroute. Businesses paused investments. Consumers absorbed price shocks. But eventually, the shocks eventually faded. And then when they do, underlying demand can reemerge suddenly. The one big beautiful bill stimulus kicks in. The bill, framed as an American industrial and reshoring package, injects construction spending, defense procurement, energy infrastructure funding, domestic manufacturing incentives. This act acts like a fiscal accelerant poured onto already warm economy. What you don't want too much growth too fast because that creates inflation. And by the way, December 10th, we are probably going to be looking at a decrease in rates, which is bad combination. Number 3, inflation moves higher, right? From an already high level. This is a key risk. A reacceleration in growth sounds good, but if the demand rises and supply remains constrained, prices will rise again. This is a second wave inflation event, historically more dangerous than the first. Remember back in the 70s, inflation cooled temporarily, policymakers eased too soon, and inflation surged back even harder. The risk here is identical. A premature victory lap leads to a reignation of inflation, forcing more severe tightening later. Remember, productivity gain in 2026. Yes, that is a risk. That is a risk because the big, beautiful bill, trillions are going to be coming into the economy, believe it or not. Risk number 2. Global industrial renaissance boosts growth and competition. So basically, the global industrial renaissance boosts with countries homeshoring advanced manufacturing and investing heavily in infrastructure, energy, defense, supply chain. Well, that sounds like a positive development. So why is this a risk? Remember, because global industrial expansion brings a surge in commodity demand. Have you seen copper, steel, lithium, rare earth? Remember rare earth? Natural gas, everything becomes scarce. Higher input costs, higher consumer prices, persistent inflation. Don't forget to subscribe to this channel, which is called The Black Swan, because I will help you find out what's going on and what are the risks in the economy and the stock market. B, intensified geopolitical competition. When every nation accelerates, defense manufacturing, energy interdependence, semiconductor capacity, coordination between nations deteriorates. We move from global cooperations to global competition. Domestic cost pressure. Homeshoring is expensive. Labor cost becomes higher. Environmental standards are stricter. Infrastructure needs modernization. This raises inflation even more. Exporters lose leverage. China, Southeast Asia, part of Europe face declining U.S. dependency. Right? This could trigger economic retaliation or stealth dumping strategies. This one you're gonna understand. Risk number 3: the new Fed chair cuts interest rates for political reasons. This is one of the most explosive risks on the list. It says that the new Fed chair lowers interest rates purely for political reasons. This cuts directly into the credibility of the Federal Reserve, and this is why this risk is profound. One, markets expect the Fed to be independent. The entire Treasury market, $27 trillion, function on the assumption that rate policy is data-driven and that the Fed is insulated from politics. A politically motivated rate cut breaks that assumption. Cutting too soon could trigger runaway inflation. If rates are slashed while wage growth is strong and fiscal deficits are massive and global supply chains are unstable, inflation could surge again. Investors would demand higher long-term yield. When trust is questioned, bondholders raise required return. The long-term rates rise and the mortgage rates rise and corporate credit spreads widen. So, ironically, political rate cuts may lead to higher borrowing costs. Because if the Fed lower the rates, right, and the market does not believe in it, and they say, you know what, there's risks in there, they could start dumping the treasuries, which would lead to higher rates. And that's the rates that your mortgage is based off. Your mortgage is not based on the rate set by the Federal Reserve. The Federal Reserve is only playing around with the Fed fund rate, which is the rate at which each banks lend money to each other. Your mortgage is set on the 10-year yield. So you could have, if the next Fed will decrease interest rates to please the president. Well, that's exactly what's happening. Although he doesn't want to please the president, but if he doesn't, it's going to be a mutiny. The dollar could weaken sharply if the Fed is seen as compromised. Foreign holders reassess U.S. credibility. This is not a small risk. This is a fundamentally destabilizing. They could say, you know what, I'm not buying treasuries anymore because you guys are not for real. And then you've got huge rates. And don't forget, you owe $37 trillion. If that treasury yield starts going up, how are you going to pay it back? Risk number 4. Well, so we have to talk about the AI again. The risk is that the AI bubbles burst. So AI has been the engine of market performance, as we know, the Magnificent Seven. We keep talking over and over. A sharp correction in AI expectation could erase trillion in wealth, trigger algorithmic selling, freeze corporate investment, and ripple through pension fund, ETF, and all that. AI infrastructures requires data centers, as we all know, hyperscaler chips, fiber networks, cooling technology, and power generation. If the bubble bursts, CapEx freezes. And when CapEx freezes, growth slows. So then you have the wealth effect reversal. Basically, high-end consumer spending is extremely sensitive to stock market wealth, to crypto wealth, to vested equity compensation. A correction hits luxury good, travel, autos, real estate. I guess you feel poorer, and then therefore you don't spend. The AI pullback could leave overbilled teams, inflated salaries, unprofitable startups, excess could spend commitment. This becomes deflationary force, but not the kind you want. And then, of course, political and regulatory fallout. A bubble burst invites regulations, hearings, political intervention. Historically, bursting bubbles led to lawsuits. Lawmakers seek blame. Regulators tighten oversight. Remember 2008? All of this slows. All of this is going to slow the innovation further. And of course, risk number 5, a dramatic increase in fixed income supply. Let me explain. This is a classic supply and demand imbalance. The government borrowing keeps rising. As we know, record deficits require record treasury issuance. More bonds, lower prices, higher yields. Hyperscalers are issuing debt. Tech giants, funding AI infrastructures require a massive amount of capital. Data centers, battery farm, chip manufacturing, transmission lines. When hyperscalers flood the market with corporate issuance, they compete directly with treasury supply. Fixed income investors demand higher yield. To absorb the trillion in new supplies, market will force higher long-term yield, wider corporate spreads, weaker balance sheet for over-levered firms. This is a major risk for REITs, private credit, commercial real estate. So then it becomes a feedback loop. Higher yields increase higher interest costs, means larger deficit, more issuance, even higher yields. So these 5 risks on random, they form a systemic pattern. The economy reaccelerate. Global manufacturing heats up. Political pressure mounts on monetary policy, and market hinges on an AI boom, and deficit creates unstoppable supply pressure in the bond markets. Taken together, this risks, the world entering 2026 with extraordinary uncertainty, and this is what this channel is about. This channel is about the black swan. We want to look for the next thing that's going to happen that it is not good, but we want for it to come around before it comes around. Okay? Next. Next. Yes, I think you should buy, but I'm here to explain to you, make sure you understand the risk. Let's take a look at the wake-up call, because the chart we're going to take a look at comes directly from Goldman Sachs and raise a critical question. Take a look at it very carefully. Could the AI trade trigger a 15% to 20% correction in the S&P 500? This is not clickbait. This is not hype. Goldman is basically showing in hard numbers that the AI boom may have outrun even the most generous estimates of future earnings. So let's take a look at it. Let's talk about line by line. So what is this? What is this graphic shows? Well, basically the graphic compares the change in market cap, and I would say at this point in terms of Bitcoin I think is at 89,000 right now. So let's be careful. The change in market cap from November 2022 to November 2025 across AI-related companies, including semiconductor companies, hyperscalers, the big cloud providers, private AI companies, OpenAI, Anthropic, etc., and others, versus the Goldman Sachs estimate of the present discounted value of potential AI capital revenue. In simple terms, it shows how much market value AI has created versus how much earning AI is likely to generate. I would not say that nothing is safe. I would say that everything is becoming more complicated. And when you don't understand something, you're fearful, right? Like the big black forest. Well, yeah, you should be concerned, but you have no choice, right? You cannot avoid it. So you better understand it. Okay? Don't forget to subscribe. and take a look at my Patreon channel, because I make more specific recommendation to get to take advantage of this situation, because you can make money. So the bars compare the actual market cap gain in blue, the estimated AI revenue value in red, and the baseline upper bound and lower bounds model. Basically, you have the current and the projected AI capex. So as the market priced in more AI value than AI can realistically produce, it's possible. So if you move to the right, the S&P gains. The S&P 500 already roughly at $22 trillion in market cap from late 22 to late 25. A large portion of this came from AI enthusiasm. NVIDIA, right, Microsoft, Apple, blah, 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 Tesla. These 7 companies, okay? These 7 companies are basically contributed more than half of the index total gain. AI sentiment lifted the entire market. This is fantastic, right? So the blue bar, which is the TMT AI basket and private company, the blue bar, isolate the AI exposed ecosystem, semiconductor, hyperscalers. It shows that this segment grew by 10 to 12 trillion dollars since the start of the AI boom. The upper bound, the red bar, more optimistic scenarios suggest AI long-term discounted revenue could be worth around 18 to 20 trillion. This is the best case fantasy scenario. And then, of course, you have the baseline, which is the red bar. This is the center of the fairway projection, roughly 10 to 12 trillion. And then you have the lower bound, red bar. This is more conservative, only 5 to 6 trillion in AI-related value. So the issue is this, right? The final bar shows expected AI capex of around 3 to 4 trillion cumulatively. This is crucial. The market has added multiple trillions in value, yet only a small fraction will come from capex itself. Right? So if you're spending, you're worth at least what's being spent, right? But it's only a fraction. Only a fraction. A lot of it is overpriced. So let's look closely at the bar. The actual market gain exceeds the PDV estimates even at the upper bound. The market has a problem. AI stocks may have gone ahead of the fundamentals. Basically, what we're saying is that if AI delivers a high-end scenario, valuation might be justified. If it delivers the best line, valuation are stretched. And if AI delivers a low-end scenario, the market is in a bubble territory. That is why analysts are warning of a potential 15 to 20% S&P 500 correction. A correction in the magnitudes occurs when earnings fell short and capex slows. So the question is, so what do we buy today, right? What do we buy? Well, you buy when nobody else is buying. You do not, pile in. You don't want to pile up into more Magnificent Seven. You want to buy small caps. You want to buy low valuation. You want to buy mostly. I wouldn't stay too close to treasuries. Be careful, because treasuries, with inflation going up, I'm not so sure. So you want small caps. You want low valuation, low debt. You want some gold stocks. You also want rare earth minerals, and you want to go internationally, because they're doing a lot better than we are. I will tell you that. I hope this is clear to everyone. Now, so the real danger is this. AI-related companies now represent 35% of the entire S&P 500. This means that if AI corrects, the whole index corrects. If AI capex slows, semiconductor demand collapses. If AI adoption disappoints, hyperscaler earnings weaken. If regulation hits, multiple contract. The multiples will definitely contract. The entire market is lashed on the mass of the AI performance. And the value chain is very narrow. NVIDIA again, AMD, Broadcom, Microsoft, Amazon. That is very tight. A small shock to any part of this chain creates cascading effects. Private AI valuation distort public markets. So is the AI capex boom sustainable? That is the question. Let's focus on the green bar. So basically, we're looking at current plus projected AI capex, and is dramatically smaller than the market cap gain it has induced. This raises three critical questions. Are hyperscalers overbuilding? Amazon, Microsoft, Google, spending tens of billions of dollars each quarter on GPU, data centers, electricity capacity, fiber network. But will this infrastructure produce sufficient returns? Is there real economic demand for AI? Or is the demand artificially inflated by corporate FOMO, fear of missing out, investor hype, inflated expectation, speculative use cases? What if monetization is slower than expected? So, this correction is not made lightly, obviously, right? Where the market cap of expected doubles or triple faster than revenue, risk builds. But, it may catch up. CapEx cycles always overshoots. Historically, every major CapEx boom from railroads to telecom to cloud computing ended with overbuild, consolidation, price deflation, earning disappointment. And of course, AI is too concentrated. A handful of companies drive all the gains. Macro conditions could worsen. But of course, don't get on the bandwagon all the time, right? Because this unwind could be violent. Because AI enthusiasm is universal with a little skepticism. And frankly, I'm sure many of you don't really understand what AI is about, right? Any disappointment could trigger algorithmic selling, ETF outflows, and sentiment collapse. A 15 to 20% correction is not a crash, it's a repricing, and could erase trillions of dollars of wealth. AI is the most important investment themes of the decades, but it's also the most fragile, right? If AI delivers on the upper bound of projections, the rally continues. If it doesn't, a correction is almost guaranteed. Either way, we are entering a period where market performance is tied to a single technology thesis. It's a very promising thesis. It's a very interesting thesis, but it's very dangerous. Next. It will correct over 40%. I don't know about that. What about the RAM shortage? It's true. Crypto is not a scam. Okay, crypto is not a scam. Crypto is real. Crypto is real. It's just you have to know what to do with it. You have to know how to spend it. You have to understand it, and that's the difficult part. Don't forget to subscribe to this channel because I will explain to you what's going on. 4-year cycle is over. Cello P is highest ever. That is true. The only thing is, what you have to realize, one thing, is that so the P is a price to earnings. So as the prices go up, the P goes up, right? But the more people talk about what I'm talking about, which is we are going to we're going to lose money. We're gonna have a crash, and be careful. It keeps everyone honest, right? and that leaves time for earnings to catch up. So if you have a price to earning which is $100 over $10, let's say, right? You say, oh, it's too much. 100 to 10 times is too much. Let's say the 100 stays where it is, but instead of making $10, you're making $20. Now your P ratio went from 10 to 5. You have to wait. Quantum stocks, yes. Good question. I have made a couple of recommendations. I'm starting to track the quantum stocks in my portfolio right now. They are doing, unfortunately, they're all losing money. Quantum stocks are losing money, but in my Patreon channel, I've started making recommendations and following them. I'm losing like 10%. I mean, I'm making like 100% on the gold stuff, on the small cap stuff, and on the small caps really. Bitcoin, I was starting to lose. I got out, and also got out of with quantum. I mean, I didn't sell yet. I'm holding. It just quantum, unfortunately, is very much. It's complicated. You know, basically, let me quickly. Quantum, basically, what's going to do? Quantum is going to speed up your computer by 10,000 times. 10,000. That's going to change again everything. Okay. And of course, these companies are going to make money, but not all of them, and right now they're losing money, but they've got lots of cash to keep them going. So let's think positive. Let's think a bit positively and take a look. Semiconductors, you have to be very careful. You have to be very careful because the U.S. is losing the race. Now the U.S. the government is investing in semiconductors, but Intel is as a foundry is gone. Right? And they're not doing much of anything. You need to diversify, but like the same way Warren Buffett says, and I agree, you should only diversify in what you understand, not on what people are telling you. Don't listen to everyone because they all have something to sell you, and it is not always a good thing. So let's take a look at this chart. It's a chart that is making waves across Wall Street right now. It shows where major bank expects the S&P 500 to go in 2026. And what those forecasts reveal about inflation, interest rate, corporate earnings, and political risk. This is not just a chart about prediction. It's a roadmap, and I will show you why. But basically, the chart displays the S&P 500 index from 2024-25, followed by dash forecast line extending to 2026 and 2027. A few key details stands out. One, the S&P 500 is shown rallying sharply into late 2025. A dotted vertical line means Liberation Day, a political reference widely, interpreted from the, you heard about it. You remember the Liberation Day, right? After this point, the index assumes a strong upward trajectory, right? So basically what we're saying, multiple banks, Deutsche Bank, Morgan Stanley, UBS, JP Morgan, HSBC, Barclays, SocGen, BofA, each present forecast lines showing what they expect the index to end in 2026. That is why you have to be careful, because if you get out of the market, you may lose out on something. And here's the headline. Every single major bank expects the market to rise further, some modestly, some dramatically. The most forecasts cluster around 7,200 to 7,500. Don't sell everything. Never, ever do that, right? But don't wait either, because you're going to lose out. Let me explain. Right now, what's happening is we are basically mimicking all of the other crashes in history. I'm talking about the gold thing, the dot-com bubble, right? But there's more to go, right? There's at least a year before this whole thing collapses. These people are going to keep spending more money on AI for at least a year, right? For the simple reason is they're still trying to figure out, and they don't want to lose out, and they've got plenty of cash. Okay, most forecasts cluster around 7,200 to 7,500, but Deutsche Bank and BofA project the most bullish outcome, almost 8,000. 8,000. That is a lot. So why Wall Street expect to continue to rally? Well, let's try to understand. So basically, the Magnificent Seven continues to dominate index earnings, right? Banks expect continued capex investment in AI, cloud builds out, hyperscaler chips, data centers, automation tools. Don't forget to subscribe to the channel. I need you. I need you to support this channel, okay? AI-driven productivity gains. These translate, and give me some thumbs up also. That would be fantastic. Am I getting some thumbs up here? Thank you. Thank you very much. I'm a glutton for punishment here. Lower interest rates. So even if inflation remains above target, thank you guys. Many banks anticipate, what I'm telling you now, I charge people for this. But anyway, even if inflation remains above target, many banks anticipate rate cuts by the new Fed chair, political pressure to ease, long-term yields falling as recession fears fade, and improved credit access. So they're basically banking on the Fed lowering the rates. And they know that lower discount rates is going to lead to higher equity valuation. That's why if the Fed, for whatever reason, I mean, they'll take him out, and I don't know what they're going to do to him if he doesn't lower those rates in December 10th next week. And we'll track that. Number 3, fiscal expansion. Thank you, Liama 8308 and 4911 Martin. I appreciate that. Fiscal expansion continues. Post-2025 stimulus from industrial policy, defense spending, reshoring incentives, infrastructure packages. This is the big, beautiful bill. Number 4, global industrial renaissance. Now, you remember that what they're saying is, well, actually, it's good. The big, beautiful bill is great because it's going to lead to more and more and more, expansion. Of course, you're going to say, but no, it's not good because then it's going to create inflation. The global industrial renaissance, just like in the earlier risk memo, countries are onshoring, supply chains are being rebuilt, manufacturing is being revived, energy infrastructure is expanding. All of this boosts global growth, supporting U.S. stock earnings. Liberation Day. It was a political turning point. Market expects regulatory rollback, business-friendly policies, lower taxes, deregulatory action in energy, right? Changes in labor and immigration. This is perceived by Wall Street as liberation from policy uncertainty and restrictions. We are removing a lot of the uncertainties left from 2024, 2025 because election year volatility disappears. Investor psychologists will shift from fear to optimism because you'll understand it. As seen historically, Reagan in 1991, Clinton in 1993, Trump in 2017, political transition often unleash optimism-driven rallies. This implies that major bank thinks 2025 marks the beginning of a more pro-market period. Now, let's examine the spread of expectation. Deutsche Bank, the most bullish, 8,000. What is Deutsche Bank thinking? They're thinking aggressive AI profit expansion. Makes sense. Expectation of low rates. That's true. Strong consumer resilience. Hey, 3% GDP so far. A Goldilocks macro scenario and possible productivity boom. Bank of America, extremely bullish. Multiple expansion. Tech-led in earning growth, stable inflation despite fiscal spending. These institutions cluster JP Morgan, HSBC, UBS around 7,400. Inflation persistence, geopolitical disruption, although they're concerned about that, they're concerned about rate cut policy, and they're concerned about supply chain side shocks. So basically, you got the people saying, 8,000, lower rates, AI, and then you have the other guys all the way down and say, yeah, AI, all that, but what about inflation? What about geopolitical risk? So all these things could be happening, rate cut maybe because of politics. So what does this tell us about Wall Street confidence? Well, markets usually show a range of outcomes. Zero banks forecast a decline, zero bank forecast stagflation, and zero banks project a recession-led sell-off. There's no way we're not going to have a recession. Okay, Wall Street believes the AI boom is not over. That is crucial. Despite warning of an AI bubble, banks think that earnings are expanding, productivity gains are real, capital expenditure remains strong, and demand for chips or data center is enormous. Bank expects policy support, as we've seen, the rate cut, deregulation, the big beautiful bill. This creates a supportive environment for equities. And the consumer is still strong. Rising wages, rising real income, expanding credit. I mean, everybody's making money. So the bear case is not on the chart. There's no inflation reacceleration. There's no bond supply shock. The money that we owe, nobody cares. AI bubble bursting, geopolitical shocks, gross margin compression. None of this is in the works. So this tells us that Wall Street is betting on a powerful continuation of the bull market into 2026, even higher, because now you understand the risk and you still want to go for it. Driven by AI, policy support, AI and Tesla making robots at $30,000 each. The forecasts vary in magnitude, but not direction. Every bank is pointing up. Every forecast assumes higher earnings, and none are predicting recession. The 2024-2025 bull market will evolve into a 2026 supercycle. What you need to worry about is not what you know. You need to worry about what you don't know. That is the question. You need to worry about what you don't know. Exactly. 2008. No one expected that. That is what you need to worry. You need to worry about what you don't know. What the heck kind of statement is that? You have to worry about what you don't know. Wow. So what do I do with that information? No, this is important. This is important because if you know that you don't know, you're always looking out. You're always looking out for the next thing. That is a reason why I created this channel. I created this channel, which is a black swan, after Taleb Nassim that wrote the book about the black swan in 2008, because they said, hey, we're talking about crypto. We're talking about lots of things here. Because they said that time, hey, do you think something is going to happen to the economy? And they said, no, I mean, the housing market is doing great. I just bought my house for $300,000. I just sold it for $400,000. Everybody needs a house. Rates are low. Well, how bad could it get? You did not know what was going on underneath the covers. And there was a lot of things happening. The point is, you need to get up in the morning, and this is always the case. You need to realize that you don't know what is going on. You need to be like Taleb Nassim, and forget Taleb Nassim. Let's go back a couple of centuries. You have to be like Socrates. Socrates was a philosopher, and you know what he said? He says, at the end of my life, I realized that I don't know anything, but I know that I don't know. If you get up in the morning and say, yeah, I think I got this thing, we are going to make lots of money in the stock market. If you didn't realize what was going on, then you know what's happening. You don't understand anything. Therefore, you are going to be in trouble. Like if you think right now, oh, everybody says that we have an AI bubble, I should sell, therefore. Don't do that. Don't do that because you're going to miss out. What are you going to miss out on? Well, you're going to miss out on the whole situation having to do with the AI bubble. Right? I mean, look at the Bitcoins. Look at Bitcoin prices. I just put it. It's trading as we speak. What is it? 89,000 or something, right? Look how red it is. Does it mean you should avoid cryptocurrency altogether? No, you need to understand what it is. Again, like I said, I am bullish right now. I am bullish for the simple reason is we're talking about it not being safe. I like that. I like when people keep saying, we're going to crash. We're going to have a problem because people are watching, they are being honest, and they're repricing everything accordingly. You need to worry because what you need to worry about is when everybody says everything is great. Then, my friend, then you've got a problem. Therefore, you need to be careful. Now, what could happen? It's the stuff that we don't know. What is the stuff that and this is what this channel is about, and that's why I want you to join the channel, and please give you some thumbs up, okay? And like, and if you've got a couple of bucks, you may want to join my Patreon channel because there I give you the list of what I'm thinking about, some of the stuff. We're becoming more specific. Not that I have the secret of everything, but I'm always looking for risk. And I will tell you right now, no one has talked to you about risks. They don't. They tell you a great money you could make. They tell you, listen to me, and this is going to happen, and that's going to happen. But they don't know. They don't understand what's happening. They think they know, but they do not. Why? Because no one knows what's happening. That's the sad part. Because if someone had the solution, first of all, they're not going to tell you. They're going to keep it for themselves. So right now what's happening, you got two things going. One, rates are going to go down. That is a huge catalyst for stocks. Okay. Two, yes, the market is overbought. Yes. But the thing is, we're talking about, I will explain to you what Bitcoin is about. It's like, it's like electricity all over again. Imagine. Okay. Now, Bitcoin, okay, one thing you have to understand about Bitcoin is that Bitcoins, they are only a certain amount of Bitcoins available. Where are they? Where are they? Are they in your computer, technically? It was created in 2008, and basically based on a pharmaceutical formula, right? You're able to mine them and create them, and they become real. It's a real thing. And people trade on it. You can't eat it. You can't sit on it. But it's an asset. Well, it's like the dollar. What can you do with the dollar? Can you eat on the dollar? No. The point is that because there's a finite amount of Bitcoins, they have value. And the most important one, they are built on what is called blockchain. They are stop trading and trade. That's true. They are based on they're based on Bitcoin technology. And blockchain technology, which is basically a database where you could track everything that's happening. That's what in many ways it's much more safe than putting the money in the bank, believe it or not. In terms of it being diverted and all the things that we keep hearing. Now, if you look at what's happening right now with the progression of the stock market and you're comparing it to other historical one, we may be like halfway there before it becomes too expensive. I mean, we're comparing to a bunch of different things, right? We're comparing to a lot of different things that have happened in the past, but we don't really know exactly what's going to happen. But the thing is, you have no choice. You've got to stay invested because inflation is eating your money. And you can't just say, well, I'm going to stay out. Well, you'll sleep when you're dead, right? That's what they say. what you need to realize is you need to understand the risk that you're taking. You're too focused on the amount of money you want to make. You need to be focused on the amount of money you're going to lose. When you cross a street, you are looking left, then you're looking right, and then you cross the street, right? Where is the Bitcoin stored? The Bitcoin is stored in your in your computer, basically, in your hard drive, and cannot be taken away. It's a digital wallet, yes. It's actually very safe. It's much safer than basically what the technology does is that it allows you to individualize your I don't know what XRP is this. I don't know about everything. Maybe some people there could find out. Okay, so hopefully this is helpful. Don't forget to subscribe. Don't forget to follow, and all that stuff. And I'll be back with some more tidbits at some point. But you guys could keep talking and share, since you seem to. No, crypto is not illegal. Don't say that. Let's take a Ripple. I hope this is not. It's in a ledger. No, you're right. You're right. In the past, it used to be on. Let's take a look at Ripple. Just for the fun of it. Hopefully, this is not some kind of. Let's see. Okay. Let me take a look at Ripple. XRP. So let me show you how to do it. Oh, it's a cryptocurrency. Yeah, you got to be careful with meme stocks and meme currency and fake coins also. I don't see it on my list of traded. Oh, I see what you're doing here. Yeah, thanks. Goodbye. Be right there.